Very good morning, friends. Welcome to today's session, which is on GST for construction industry. Of course, it's a topic of everyone's interest, and I'm sure that today there will be a lot of questions posed at the speaker. And today we have Mr. Natarajan as our speaker, and we all have uh, listened to him in our previous session on audit assessment. Adjudication appeals and related provisions under the GST law. And now today, sir is going to talk one more time for GST for construction industry. As I have introduced sir last time, but for the benefit of some other participants who have joined, who have missed the earlier session and who have joined this session, I again take the privilege to give a short introduction of sir. Mr. Natarajan is an ex-departmental officer who has served for a period of around 10 years in the department, customs excise and central excise and service tax department. And after that, he has started his practice as an advocate, and he is one of the lead partner in a pan-India based legal firm called Swami Associates, which has its presence across India, including Hyderabad also. And sir has authored a book related to construction industry, demystifying GST for construction industry. That's a book. And he has authored various articles which are published uh, in various journals, including taxindiaonline.com, service tax review, excise law times, and quite a few. With this short introduction, I hand over it to sir. Sir, over to you, sir.
Thank you, Maninder. Good morning to everyone. So, I request that all participants may be kept in mute so that we will not have any disturbance. But during the session, if anybody wants to raise any question, you can just raise your hand in the app so that the host can unmute you and you can ask the question. We can also have an exclusive question and answer session at the end also. But if you want to ask anything immediately, please raise your hand in the app so that the host can unmute you and we can discuss it and then proceed further. Am I audible properly?
Yes.
Okay. We'll just proceed. See, this construction industry is always having a lot of confusions with regard to its taxation. This is not something new. Starting from 1950s onwards, the confusion over the construction industry, how to tax it is time immemorial. But before we just move into the GST provisions relating to construction industry, we should have a broad understanding as to how it was there under the S12 service tax era also. So without properly understanding that, straight away jumping into GST may not be correct. So if we have to talk about the construction industry and taxation, we have to naturally start with the very famous decision of the Supreme Court in the case of Gunn and Dunkerley. So what has happened? After India attained independence, we have got our own constitution. The powers of the government, union government and state governments, were divided between them. We all know 7th schedule, list 1, list 2, list 3. All legislative powers have been shared between the union government and the state governments. Similarly, the taxation powers were also divided between the union government and the state governments. That the power to levy a tax on sale of goods, the power to levy sales tax on sale of goods, that was given to the state government. In the earlier period, government wanted a lot of money because after independence, we have to think of our economic development. We have to take care of our poor people, help them come out of the poverty line. So government wanted to increase their tax base. This trend continued even late up to somewhere in 1990s also. So when they were looking for more and more avenues to tax, it was the Madras government, they imposed sales tax on construction activities. So the idea was, when you are giving a construction work to a contractor, the contractor is using cement, steel, etc., and he is giving it back to you in the form of a building. So there is a transfer of property with regard to the goods, cement, steel, etc. So why can't we levy sales tax on that? So the Madras government, with the help of their sales tax law, they levied sales tax on construction activities. That was challenged, and the challenge reached up to Supreme Court. The Supreme Court finally said, sale means, it means there should be a transfer of goods, chattel, movable goods. But here what happens, the cement, steel, everything is going into the building. It becomes an immovable property. And finally, only the immovable property is transferred. So this cannot be considered as a sale transaction. So the Supreme Court has struck down the Madras government's attempt to levy sales tax on the construction activities. So this decision came as a very shock for the government because there were a lot of revenue potential in this. So what they did, the Law Commission has also considered this aspect. And finally, they wanted to amend the constitution. So a concept of deemed sale was brought in. Sale means sale of movable goods, no problem. But a deemed sale concept has also been brought in by virtue of amending the constitution. One of the deemed sale was whenever there is any execution of work contract, like construction activity, there shall be deemed to be a sale of the material involved. Which means if you are engaging a contractor to construct a building for me, then the contractor is selling cement, steel, wooden items, etc. to me. That is the presumption. It's called a deemed sale. And from that time onwards, the state governments have been levying sales tax on that. Then we know in 1994, the government thought service sector is contributing maximum for our GDP, but we are not taxing the service sector. So service tax came to be introduced in 1994 in small way. So every year they introduced new services, and finally it reached up to around 120 services. And in 2012, a negative list based levy was also introduced. So the government realized when the construction activity is taxed by the state governments already on the goods component, there is also a service component in it. So we will put service tax on the service component involved in the construction activity. So for the first time in 2004, commercial construction activities were made liable to service tax in 2004. Then came the residential complex service. If a residential complex is having more than 12 apartments, that was brought under the service tax levy from 2005. See, construction activity involves goods also. We know that it's a deemed sale. And central government cannot levy tax on sale of goods. They have the power to levy tax only on the service component. That too, not with any separate entry 97, residual entry. So, only the service portion can be subjected to tax. So, what the government thought, we have to exclude the value of goods from the levy. We have to exclude the value of goods from the levy. So, how can we do that? They gave exemption notification. We call it as abatement notification. So, what the government thought, we will exclude on an average 67% of the total value is exempted. So, you are liable to pay only service tax on 33%. So, in the presumption of the department, the service component will be on an average 33%. So, 67% was given as an exemption. And this is where the problem started, and we will see that later. So, then what happened? This was going on. Slowly, people were getting themselves registered. They were claiming abatement. They were paying service tax also, even though the complaints was not up to the expected levels. But people have started complying. Then, in 1/6/2007, the government introduced a new service by name called work contract service. If you read the budget speech of that particular year, 2007, at the time Mr. Chidambaram was the finance minister, and if you see para 154 of his budget speech, he will say, the state governments are already levying VAT on construction activities. The central government should levy service tax on the service part of the work contract. So, I am proposing to introduce a new service called work contract. This is what the finance minister has said on the floor of the parliament. Then people got suspicious. Then what is the earlier service of commercial construction service, construction of residential complex service, which came in 2005? So, if the intention was the government to tax the service component of the work contract only from 1/6/2007, what is the scope of the pre-existing taxing entries, that is commercial construction and residential construction? So this debate has started, and people have started taking this particular defense. And this dispute was going on. There was one Dailing decision where they said a composite contract can be vivisected. So after vivisecting it, whichever is the taxable service, you can levy service tax like that. and it went up to larger bench and all, in between so many decisions. So what we have to understand is this particular dispute, whether a composite contract can be taxed prior to 1/6/2007. That issue was going on in various courts, and finally the Supreme Court in 2015 has held that only after introduction of works contract service with effect from 1/6/2007, you can tax a composite activity. Composite activity means where goods and services are involved, both. Because the central government did not have the power to levy any tax on the goods. It is under the state list. So if you want to tax the service component, am my voice is clear? Somebody is sending a chat message. Am I
It's
audible?
clear to me. It is clear.
Okay.
It is audible. It is audible.
Okay. So what has happened? This works contract, Supreme Court has said, if you have to tax only the service component in your works contract, you should have a legislative mechanism to arrive at the value of service. That came only from 1/6/2007. There was a Rule 2A introduced in the service tax valuation rules, and simultaneously a composition option was given. Prior to that, what was the method available? It was abatement. Abatement is an exemption notification. Exemption notifications are issued by the executive, the government. Today they can issue an exemption, tomorrow they can withdraw. So let us assume this 67% abatement notification is withdrawn on a particular date. Let us assume. So what will happen on construction service, commercial construction service? People have to pay tax on the entire 100% value. There will be no abatement. On residential construction, people have to pay service tax on the whole value. It is not possible. Constitutionally, the government cannot levy tax on goods component. How can they tax? So what has happened? It was all started from a mistaken belief of the government while introducing this particular levy. That has cost very heavily for the government, and we will see how it is. So what the Supreme Court said, giving abatement at all will not help you. It is after all an exemption notification which can be given and withdrawn at any point of time. The validity of a taxing entry should not be based on an exemption notification. The statute should stand on its own. So whatever commercial construction service, whatever residential construction service you have introduced, that will be covering only pure service activities. That is, I want to construct a building, I purchase all the goods, cement, steel, everything. I engage a contractor to do only the labor work. Then you can tax me under commercial construction service or residential construction service, whatever it is. But once it is a composite service, it can be taxed only under works contract service. That too with effect from 1/6/2007. You should understand this decision of the Supreme Court has come only in 2015. So for the first 10 years, there were a lot of confusion. Everybody believed that commercial construction service can cover composite service also. Residential complex service can cover complex service or composite contracts also. And many people were paying tax by claiming 67% abatement. So during those times, various circulars have been issued by the government. Various other decisions have also come. One important decision is, when you are claiming that abatement, part of the material you are putting. As a contractor is putting part of the material. But the client is supplying some material. Cement, steel and all is supplied by the client. So the contract value will get reduced. So now the question is, whether the value of free issue material also should be added while claiming this particular abatement. That was another important issue that was also litigated, and finally it reached the tribunal larger bench and then Supreme Court also. There it has been held, when you are claiming 67% abatement, there is no need to include the free supply material. But we should understand, all these decisions were before L&T. After L&T, this decision has become infructuous, because once you are not at all liable to pay any tax, there is the question of abatement and including free supply, and also this time difference between L&T decision and other decisions we have to know very carefully. And VAT and service tax, they are mutually exclusive. So the same activity cannot be subjected to both VAT and service tax. Even though that is the legal position, practically we see the breach in software and all, it is being breached. And construction activity also, there will always be an attempt by the state government to levy maximum tax on maximum value. Same attempt will be there by the department also. So all those litigations, whether composition benefit is available, if I have paid tax prior to 1/6/2007 under construction service, and we switch over to host contract. Can I opt for composition scheme? This litigation has its origin to Hyderabad. I think the great man behind it, Mr. A.R. Babu, is also joined us in session today, I think. And in fact, I owe a lot to him, because whatever my knowledge I have gained in the construction sector, it is all because of the questions put forward by clients like Babu, who is also attending today. So now, Natarajan, they have challenged this particular circular. We went up to Supreme Court, but unfortunately we lost, saying that you cannot switch over to composition scheme. But this decision has also become redundant after L&T. Once I am not at all liable to pay any tax prior to 1/6/2007, that is the question of ongoing projects, switching over, option, nothing is required. So you can very well opt. So whatever our understanding prior to L&T decision, everything will go for a toss after L&T decision. This we have to bear in mind. And before we proceed, another important aspects which we have to notice, basically there are two models under which this construction activity, especially the real estate, residential sector, is carried out in our country. Yes, sir. Okay, I'll proceed. So basically, there are two models broadly. One model is, especially in my state, Tamil Nadu, if I want to book a residential apartment, I will go and negotiate with a builder. A formal agreement will be entered, and the sale deed will be only for the land portion. Undivided share of the land will be registered in my name. For the guideline value, stamp duty will be paid. And for the remaining amount, a construction agreement will be entered into the construction agreement. So if you see the construction agreement, that is only for the construction activity. Land value is not there in it. Land value is separately through a sale deed. So the construction agreement by itself will be a host contract. This is the model followed in most of the southern states. But if we go to states like Maharashtra and all, the situation is slightly different. So what they will do, once you book an apartment, an agreement will be entered. They will get the money in periodical installments. And finally, after the construction is complete, the sale deed will be for the whole value. There will be no breakup for land value and the construction value. On entire value, stamp duty will be paid. So this is the transaction of sale of immovable property at a future point of time. So ultimately, for the entire value, there is a sale deed. It is sale of immovable property. There is no host contract in it. There is no construction agreement. So what will happen? The period from 2005 to 2010, what will happen? Those activities cannot be brought under the definition of construction of residential complex service. So the government has introduced one explanation in 2010. So because please note, L&T came only in 2015. So in 2010, government has introduced an explanation in that particular definition, whereby they brought that Bombay model also under the service tax levy. They said, once you book the apartment, before completion, if you pay any advance amount, that will be deemed as a service. You may be paying the sale deed for the entire value, but any amount paid in advance, it will be a service transaction. So like that, a deeming provision was introduced in 2010. And another important and most complex area is this joint development. So briefly, we will just understand what is joint development, and then we will see what are the provisions relating to GST for joint development later. So joint development is a model where the landowner and the builder, they will come together, they will join together, and the landowner will give the right. The right of development will be given by the landowner to the developer. The developer will put his own money. He will get all the permission. He will undertake the construction, and the total constructed area will be shared between the landowner and the developer in an agreed proportion. This may be a commercial building or a residential building. Joint development is possible under both. So either it will be on a area sharing model. So sometime what will happen? The landowner says, I don't want any building and all. You sell everything, but give me 50% of the sale proceeds. So that we call it as revenue sharing model. So in this model, there is an element of service provided by the developer to the landowner. So how to treat it, we have to see. So this is the broad provisions under the service tax era. So from 1/7/2017, GST was introduced. Construction activity is also covered under GST. So now, earlier, we always had a doubt whether to treat it as a service transaction or a sale transaction. Under the old law, the construction activity involves both deemed sale and service. So both the government were levying taxes and there will always be dispute about the valuation. So now under GST, the taxable event is the same. It is supply. Both the government will levy equal amount of tax. So there will be no fight between the central government and the state government that this is mine. So that is avoided under GST. So they have specifically said works contract is a service. Don't treat it as a goods at all. Works contract will be deemed as a service. This is specifically mentioned under Schedule 2. And similarly, the Bombay model, which I was telling earlier, even though the house or the building is sold by executing a sale deed, if any amount is paid before obtaining completion certificate, that is during the stage of construction, if any payments are made by the client to the contractor or the developer, that is also deemed as a service. So both the government will be levying the tax. This was the position when GST was introduced. Then came an important development, we can rather call it as a bombshell, a notification 4/2018. So far, our understanding was when the developer is selling the apartment to various buyers, there is an element of service. There is an element of service which is liable to service tax, VAT, and after GST, it is leviable to GST. So there is a supply of service from developer to buyers. And we also know there is an element of supply of services by the developer to the landowner. So again, that is also a disputable issue. Some people may argue there is no service in that, but still broadly, there is a service element involved between the developer and the landowner also. This particular notification for the first time has recognized the landowner is also providing service to the developer. In joint developments, the landowner is giving the development right to the builder. The builder or developer. I'm using all the terms. There is no, as far as this session is concerned, there is no difference between the word developer or builder. So all these terms I'll be using it simultaneously. So this notification has said, in a joint development model, the landowner is providing a service to the developer. That service is transferring the development right. What is the consideration for it? He is getting some part of the constructed apartment, maybe 50-50, 60-40, 70-30, whatever it is. So against the receipt of constructed apartments, the landowner is transferring the development right to the developer. That is a service. This notification does not declare that it is a service. It presumed that it is always a service. So the problem will come even prior to this notification also. Not only that, even for service tax period also, this view can be taken. In fact, it was taken. I will come to that later. So the landowner is providing transfer of development service to the developer, and this notification said when the tax has to be paid by the landowner for that, at the time when the constructed apartments are transferred. When the constructed apartments for the landowner share are handed over or conveyed by the developer to the landowner, at that time the landowner should pay GST on transfer of development right. That's what this notification has said. Now, what is the value to be adopted? The notification presumed that whatever constructed apartments are being given, that is the value. We have to value. Suppose there are 10 apartments. We will have examples also. We will see that later. So here only one point which I want to mention. The landowner is not only transferring the development right, he is also parting with his land. The part, that is for the builder's share of apartment. Let us say 50-50 model. When the builder sells his share of 50% apartments, he will also sell it along with the UDS land. He will also receive money towards that UDS land. He will retain it. So there are two activities from the landowner. The landowner is parting with a part of his undivided share of the land, and he is also transferring the development right. So two things are flowing from landowner. In turn, he is getting constructed apartment. So the value of the constructed apartments received by the landowner should be apportioned between the value of TDR and value of land transferred by him. Land transfer is an immovable property, no GST. So after reducing the value of land transferred by the landowner, on the remaining value only, the TDR GST is payable. This is not stated in the notification. This is only by way of interpretation. So otherwise, on the whole value of the apartment, the landowner will be liable to pay the tax. Now, this was going on for some time. So up to 1/4/2019, the position was like this. The tax rate on construction activity was 12%. But actually calling it as a 12% is a misnomer. If you see the notification, there will be no 12% mentioned. So most of the people used to say that it is 12%, 12%. Actually, it is 18% on 2/3 of the land value. 1/3 of the value should be reduced towards the land value. On the remaining 2/3 value, 18% if you apply, effectively it will be 12% of the total value. That is how we got the 12% rate. Otherwise, there is no 12% rate as such. So whether it is a residential apartment or a commercial complex, the rate of tax is 18% on 2/3 value or 12% on the total value. And there are certain affordable apartment schemes introduced by the government and all. So for those schemes, affordable apartments, the rate will be 12% on 2/3 value, which will work out to 8% on the total value. So this was the rate structure. ITC is eligible. All ITC can be taken. There are no restrictions except 17.5. Restriction can be taken. For all other, see for example, the builder is appointing a contractor. The contractor will buy cement, steel, and he will do his labor and he will provide service. There will be no land value involved between the builder and the contractor. There is no transfer of land by the contractor. So on that activity, the rate will be straight away 18%. But between the builder and the buyer, land value is also included in the total price. So 1/3 will be deducted for land value. On 2/3, 18% will be applied for normal apartments and commercial buildings. And for affordable apartments, it will be 12% on 2/3 value. By and large, things were simple. Everything was going on fine. But if everything was going on fine, how should we ensure that our business is going on? Maybe realizing that the government has come out with lot of amendments with effect from 1/4/2019. In fact, whatever confusion or complications have started after 1/4/2019, nobody else should be blamed. It is only the industry. They lobbied and they wanted a rate reduction. They said that our industry is suffering. Lot of unsold units are there. The recession is there. This GST is causing a heavy burden on us. So you please reduce the rate. So they didn't realize once the rate is reduced, definitely they will not, or the rate is made as nil, there is a possibility of losing the ITC credit. So that they didn't realize. They asked for a rate reduction, and finally the government has brought a rate reduction with effect from 1/4/2019, but with lot of complications, which made the process very, very miserable. So it becomes very, very difficult for any common man to understand these provisions. So now we will see what are all the changes introduced from 1/4/2019. First, what has happened? For the residential sector, the rate was reduced to 5%, from 12% for normal residential apartment, not the affordable apartment. Only for the normal residential apartment, the rate will be 7.5% on 2/3 value, so which will come to 5%. Again, there is no 5% rate in the notification. It is 7.5% on 2/3 value. This is for normal residential apartment. For affordable apartments, affordable apartment is also defined. How much area and what should be the value and all, everything is defined in the notification. So now, for affordable apartments, the rate is 1.5% on 2/3 of the value, which will work out to 1%. So we have to understand certain terms here. REP is a real estate project. RREP is a residential real estate project. So in an RREP, that is residential real estate project, there can be some small commercial area also. There may be a small shop, gym. So like that, some commercial area also can be there, up to 15% of the total area. So if the commercial area in a complex is less than 15% of the total area, still it will be considered as a residential real estate project. And even for that commercial area, that is which is within 15%, the rate will be 5%, 7.5% on 2/3 value. So that will be for the commercial area also. But if the commercial area exceeds 15% of the total area, or if it is a pure commercial project, no residential is involved, the rate will be the rate will be earlier rate, like 18%, 12% on the 2/3 value. 12%, no, 18% on the 2/3 value, which will come to effectively 12%. So all these amendments have come with effect from 1/4/2019. So many notifications have been issued. Lot of amendments have been made with effect from 1/4/2019. So at that time, many projects might be ongoing projects. People might have been paying at the rate of 12%, 2/3 value, 18%, working out to 12%. They were also taking ITC. So now an option has been given for all ongoing project. Either you can continue to pay tax under the old rate itself, you can continue to take ITC, or you can switch over to the new rate. So this option has been given for all ongoing contracts. Just a second. Yeah. So this option has to be exercised before 20th May 2019. Earlier it was 10th, then they gave another 10 days time. If no option is exercised, it will be deemed that they have opted for the new rate. So if at all you want to continue under the old rate, we have to file an option. It is project-wise option. So if you have some 5 projects, for some project we can opt for 1% or 5%. For other projects, we can continue under the 12% scheme. So this option has to be exercised. This option is only for ongoing project. Any new project started after 1/4/2019, there is no option. We have to go under 5%, 1%. This is about residential sector. We are talking about residential sector. So this option has been given only for ongoing project. So then, what is the meaning of ongoing project? That term is also defined in the notification. So as per the definition, an ongoing project means a project where the project work has already started. Before 1st April 2019, we should get a certificate from an architect or a chartered engineer or a licensed surveyor that the construction work has started before 1/4/2019. That is one requirement. And second requirement is completion should not have been issued before 1/4/2019. So the completion should not have been issued. Completion certificate should not have been issued. That is another requirement. And another requirement is at least one sales should have happened before 1/4/2019. So before 1/4/2019, we should have received some amount on which we should have paid GST at the old rates applicable. If nothing has been sold before 1/4/2019, it will not become an ongoing project. It will be treated only as a new project. Now, I said construction should have started. So how to determine construction has been started? Just I have put only Bhumi Puja. On 30th March, we have conducted a Bhumi Puja. So can we take that the construction has started before 1/4/2019? No. The explanation says a construction of a project shall be considered to have started if the earthwork for site preparation has been completed and excavation for foundation has started. So this should have happened before 1/4/2019. Then only it will become an ongoing project where the option and all will be available. So now, suppose a person has opted for the new rate, 5% for normal apartments and 1% for the affordable apartments. That comes with lot of conditions. So a lot of conditions are there. I will not opt. So that you can do only for an ongoing project. If it is a new project after 1/4/2019, we don't have an option. We have to naturally go for 5% rate and 1% rate. When somebody is paying under that 5% rate or 1% for affordable apartments, it comes with lot of conditions. The conditions are that particular developer who is paying 5% for the residential construction or 1% for the affordable segment, they have to procure all cement only from registered suppliers. The cement has to be purchased only from registered suppliers. If cement is procured from unregistered party, then the builder should pay tax GST under RCM. So cement attracts 28% GST. So if cement is purchased by the developer from unregistered parties, they have to pay GST on the cement purchased under RCM. They cannot take ITC because this 5% comes with no ITC. Yeah, there is one previous slide which I think I have missed. I'll just go back. So One of the main condition is this 5% GST has to be paid only in cash. You may be doing some other business. You will have a single registration. You have a lot of balance in that business. Can you pay your 5% GST on the residential apartment by using some other credit? No. This amount has to be paid only in cash. The second condition is no ITC. So once you are under the 5% or 1% scheme, we are not eligible for any ITC. For ongoing project, if we are continuing to pay GST under the old rate, then we can continue to take ITC. Then final reversal will come. At the time of completion certificate, we have to reverse. That's a different issue. But during the stage of construction, they can continue to take the credit for ongoing project. But if a person has opted for 5% for an ongoing project, 5% or 1% for an ongoing project, then whatever ITC he has taken so far, that has to be proportionately reversed. The method how to calculate that proportionate reversal is prescribed under notification 3/2019, annexure 1, annexure 2. And if you have to understand that, you should have a PhD in mathematics from IIT. So nothing less than will be sufficient to calculate all these mathematical calculations and all. You require a lot of patience to understand how this proportionate reversal has to be made. Now, going to the next slide. Cement has to be procured only from registered person. If not, under RCM, the builder has to pay GST on the cement. Similarly, if any capital goods are purchased for this particular construction activity, that also should be purchased only from a registered supplier. If capital goods are purchased from unregistered person, again, the builder has to pay GST under RCM at the rate applicable for the capital goods. It may be 5%, 12%, or 28%, whatever it is. The builder has to pay tax on the capital goods purchased by him if they are purchased from unregistered supplier. Registered supplier, no problem. They themselves will charge it. This is another condition. The next condition is when a builder or a developer is paying tax under 5% for the residential segment and 1% for the affordable residential segment, they have to compulsorily receive their inputs and input services only from registered persons up to 80%. Please note it carefully. Project wise, we have to maintain all purchase account. So, suppose if you are undertaking a residential project, you may purchase lot of inputs for that particular project. You may receive lot of services for that project, labor contractor, engineer, like the architect. So you will receive so many services. So whatever inputs you are procuring, whatever input services you are procuring, total value. Every year, total value. Out of that, how much is received from registered persons, how much is received from unregistered person. You have to maintain accounts. And you should satisfy at least 80% of your purchases are from registered persons. If there is a shortfall, suppose at the year end I notice only 70% I have purchased from registered person, 30% I have purchased from unregistered persons. So for the shortfall of 10%, you have to pay tax at the rate of 18% under RCM. Please note, if you purchase cement from unregistered person, you have to pay applicable GST under RCM. If you purchase capital goods from unregistered person, you have to pay applicable GST under RCM for the capital goods. Apart from that, the total value of inputs and input services procured by you, at least 80% should have been procured from registered persons. So all services like our labor contractor, everything will be taken here. Only the transfer of the TDR we need not take. Because why we need not take, that will come under RCM. We will see that later. So apart from that, all other materials, all other goods, we have to take into account. Then it is also better, the first 2 points. And GST should also be paid for the apartments handed over to the landowner. This they need not have even said. Even otherwise it is payable. So in the joint development agreement, for the landlord portion handed over, whatever is handed over to the landowner, that also GST has to be paid by the developer. So that is another condition. So to decide all these things, now it is little bit too late. in respect of all ongoing project, we should get a completion certificate from a approved engineer. How much percentage of completion has been completed up to 31/3/2019, that we have to understand. So now we will just move on to there is joint development and all is there. We will come to that. Before that, suppose if a person is switching over to the new rate in respect of an ongoing project, he is switching over to new rate 5%, 1%. So up to 1/4/2019, he was taking ITC. So ITC was not barred prior to 1/4/2019. So even from service tax period, he would have taken credit and carried forward under the transitional provisions. And after GST also, he would have been continuing to take ITC. Now, suppose if he opts for the new rates, 5% or 1%, then the proportionate credit has to be reversed as per Annexure 1 and Annexure 2 under Notification 3/2019. So here what happens? We will take a small pause here. So even under the service tax period, what will happen? First year, you take credit, you do some sales. All sales will be paying service tax. Second year, the project continues. The project will be continuing for the second year. You will continue to take your ITC credit, and there will be sales also. On the sales, we will be paying service tax. Third year, the project is completed. Let us assume middle of third year, we get a completion certificate. So for all the sales already made and all the sales made up to issue of CC, we will be paying service tax. We will be paying service tax prior to GST. And any sales after completion, we will not be paying because it is a sale of immovable property. Any sales after completion, we will not be paying service tax during service tax period. So what the department used to demand, they will say, see, you have taken credit in the first year, you have taken credit in the second year, third year also you have taken the credit. So all the credit should be taken into account and proportionate credit is to be calculated. Year 1 credit, year 2 credit, year 3 credit. All should be taken together and the proportionate credit to be reversed based on the value. How much value we have paid tax, how much value we have not paid tax. On that proportion, you have to reverse. Department used to make such demands. But if you see the earlier provisions of Rule 6, it was operating only on an annual basis. Every year, how much is the taxable value, how much is the exempt value, we have to calculate and reverse. In year 1, there is no exempt value. Because the project was not completed, any sales affected, we were paying service tax. So it will operate only on an annual basis. That may not be correct, but that was the position of law. So even there are judgments also. Tribunal has held that only year-wise it has to be done, not cumulative-wise. That decision has also been upheld by the Bombay High Court. So now in GST, after 1/4/2019, they have realized it and they have amended. It should be for the entire project. So now coming to the ITC reversal for ongoing project, the total credit taken from 1/7/2017, including transitional credit, will be treated as a common credit. Then, wherever we have paid GST up to 1/4/2019, where the time of supply has arisen up to 1/4/2019, to that extent we are eligible for credit. Wherever the time of supply has not arisen, the time of supply will fall after 1/4/2019, we will not be eligible for that. That is the principle. So once we understand the principle, understanding the formula and all will become easier. So ITC for to the extent of construction of residential apartments having TOS up to 31/3 is eligible, and wherever the TOS falls after 1/4/2019, to that extent the credit will not be eligible. That is the fundamental principle. So there are various caps. We have to really admire whoever was part of the government in thinking and bringing out all these formula. Lot of thinking. We have to really salute their spirit. Lot of thinking has gone into their exercise, and they have visualized what and all the mischief somebody can do. See, once you are liable to reverse to proportionate credit, people will try to do every trick possible to get the maximum amount of credit. So what will happen? It is going to be based on the amount to build pre-1/4 and post-1/4. So they will tell all the client, you pay all the amount before 1/4. If you are paying anything after 1/4/2019, the price will increase. The GST rate will change. I am not eligible for ITC. So whether the project is complete or not, you pay the entire amount. So the builders may tell the consumer, to pay entire amount before 1/4/2019. See, all these notifications have come on 29/3/2019, effective from 1/4/2019. So within 2 days, how much can be planned and how much money you can realize, I don't know. But still, it is a practical, at least invoice they may raise, because time of supply is based on invoice. And what else people can do? They can stock, they can purchase all the material requirements before 1/4/2019 and take the credit also before 1/4/2019. So that is possible, so that they will get the maximum amount of credit. So for all this, they have put checks in the formula. So you cannot, the formula is linked to the percentage of completion. The formula is also linked to the amount of invoicing and the amount realized. So everywhere they have put mathematical caps in the formula. So like that, the formula has been prepared, and in this manner, the credit has to be quantified. For the time being, I'm not going into the calculation annexure 1, annexure 2. If anybody wants it to be explained, we can see it later. But these are all the principles behind it. Now, for construction of commercial apartments, credit is eligible. Because commercial, it will continue to attract 12% except RREP. Commercial apartment, it will be 18% on 2/3. So to that extent, ITC is eligible. And one more thing which we have to note, even though wherever credit is allowed, where credit is allowed, for commercial apartment, credit is allowed. For ongoing project, if somebody is continuing to pay tax under the old rate, there also ITC is eligible. At one point of time, the project will be completed. Completion certificate will be issued, or first occupation will take place. Thereafter, at that time also, there may be unsold area. Unsold apartments may be there. If those apartments are sold after completion, it is not a service transaction. It is a sale of building, sale of immovable property. So that is not liable to GST. So whatever credit taken from the beginning, that has to be calculated proportionately. How much area? This is not based on value. Rule 42 normally operates on value basis, but here it is based on area basis. So how much area out of the total area in the project, how much was sold on payment of GST and how much was unsold at the time of obtaining completion certificate. In that proportion, the credit has to be quantified and reversed, both for inputs and input services as well as for capital goods. This reversal has to be undertaken. So this is another important requirement. There are two types of reversal. One is if somebody is opting for 5% in respect of ongoing project, immediately they have to calculate everything and reverse the credit. Some time was given. I think it was up to 30th September. September month return, we have to calculate. And this is for the people for ongoing project where new rates are opted. Suppose if new rates are not opted, they are continuing under the old rate, and at one point of time, the project is completed. For the unsold apartments in a completed project, the credit should be again quantified and reversed under Rule 42-43. In the first category, 42-43 will not apply because all the credit proportionately calculated and reversed at one point of time once you opt. So there is no further reversal after obtaining completion certificate. This completion certificate reversal will come only ongoing project who has not opted for the old rate, who has opted for the old rate, and for commercial apartments. Now, up to this, if anybody wants to ask any questions, because we'll be moving to a totally new area, that transfer of development, right? So up to this point, if anybody wants to ask any question, you can just ask me. Otherwise, we will continue and we can hear later. Anybody? Okay.
No questions.
We will proceed. Now, this transfer of development right. We have seen the landowner is transferring the development right to the builder in a joint development. So there is a tax liability on transfer of development right. So that we came to know for the first time by issue of notification 4/2018. Even earlier also, similar transfer of development rights there was demand of service tax. There is one decision recently by the Chandigarh bench of the SISTAT in the case of DLF, where on transfer of development right, service tax was demanded. So the tribunal has held development right is always attached to the land. It is an immovable property. You cannot segregate the development right from the land. So since it is an immovable property, you cannot levy service tax on transfer of development right. A wonderful decision. It's a very big, very long decision. After analyzing various high court judgments, they have come to a conclusion. So definitely, post GST also, we can take up the argument that transfer of development right is transfer of immovable property. You cannot levy GST on that. That is one legal plea which we can take. Again, I'm not saying that immediately you should stop paying. You have to take a calculated decision. This is a legal plea available, but litigation will ensue and issue will get settled after so many years. And at that point of time, unfortunately, if at all some other decision comes, you may not be able to collect the tax from your landowner. So from a practical point of view, you may continue to pay GST. But I should tell both sides. In a session like this, especially to the professionals, I should tell you both the position. So even now, we can legally argue that transfer of development right cannot be segregated from the land. So it is immovable. You cannot levy any GST on transfer of development right. This is one legal plea which we can take. But if you see all these notifications and all, the government's understanding is transfer of development right is liable to GST. So now, what is this TDR? What is this development right? It is not defined. Under GST law, it is not defined. Under the Town and Country Planning Act, every state will have their own Town and Country Planning Act. There, the concept of development right is discussed, even though there is not much of a definition. So, what is the development right under Town and Country Planning provisions is, that is something different. So, what will happen? I have a land adjacent to the national highway. I have a big piece of land. Government wants to acquire it, either fully or partly. For a highway expansion, they want to acquire it. So suppose I have some 10,000 square feet of land. In that particular area, I can construct the floor space index, that is FSI. Let us say it is 2 times. So in 10,000 square feet, I can construct up to 20,000 square feet. I can construct up to 20,000 square feet. Suppose if the government wants to take away 5,000 square feet from me, from the 10,000 square feet owned by me, the government wants to acquire 5,000 square feet, then I am losing 10,000 square feet of FSI. So government will give me a certificate. They will give me a certificate for 10,000 square feet of FSI. So what I can do with the certificate? I have the remaining 5,000 square feet. Normally I can construct only 10,000 in that. But with the help of this certificate for 10,000, I can construct up to 15,000 square feet in the remaining 5,000 square feet land. That is possible. Or suppose if the government is taking the entire 10,000 square feet, they will give TDR certificate for 20,000 square feet. I have another land in some other place. I can use this FSI in my another land also. Or I can sell this. Anybody who wants additional FSI, this TDR is a tradable item. I can even sell it in the market. So this is what is normally understood as transfer of development right. It is very difficult to believe that in a joint development agreement between a landowner and a developer, there is a transfer of development right between the landowner and developer. It is little hard to believe, but the GST notifications recognize both these things. There is a transfer of development right under JV also, and wherever the certificates are sold in the market, like those land transactions also, it involves FSI or additional FSI. All these transactions are liable to GST. That is what the government's understanding, and that is how the notifications have been framed. So the big question is, whether at all is there any TDR in a JV agreement? I can't give a final answer to this. All these issues have to be fought in the future. Now, in a joint venture, the understanding is the landowners are providing TDR or transfer of FSI to the promoter. So the landowner is transferring TDR to the promoter. That is one basic understanding we should have. And the promoters are providing construction service to the landowner. So if it is an area sharing model, they construct some apartments and give it to the landowner. So it's like a barter. The landowner is transferring TDR to the builder, and the builder is providing constructions. In both the transactions, no monetary amount is involved. It is a barter consideration, not in kind. How to value it, we should see. So both way, there is a service transaction. Now, the builder, his share of apartment, he will sell. He will sell and take the money. The landowner, his share of the apartment, he can do whatever he wants. Either he can reside himself, or he can sell, or he can rent it out. So anything can be done. So now, when that landowner sells his portion of the apartment separately, then to that extent, he provides service to his buyers. If the landowner is selling his portion of the apartments before obtaining completion certificate for the project to his buyers, then the landowner becomes a promoter. So the promoter, the basic promoter, is providing construction service to the landowner, and in turn, the landowner is again providing service to his buyers if he sells the flat before obtaining completion certificate. So we have to understand all the chain of these transactions. Now, what has happened from 1/4/2019? This transfer of TDR, the liability to pay GST is shifted to the developer. It is under RCM. So the landowners are spared from the burden. As per notification 4/2018, only the landowner is liable to pay. But from 1/4/2019, any JV entered after 1/4/2019, the liability to pay tax on TDR, it is shifted to the developer under RCM. Now, the next one, if it is a commercial project, it's a commercial project, joint venture project, there is transfer of TDR by landowner to developer. So the developer has to pay GST on TDR. TDR is a service received by the promoter, provided by the landowner and received by the promoter. So under RCM, he has to pay. For that, there is no exemption, anything. For commercial apartment, he has to pay. At the rate of 18%, he has to pay. Then he can take credit also. To the extent the commercial apartments are sold before CC, credit is proportionately eligible. Because if some commercial apartments are sold after completion, then he will not pay GST. So to that extent, credit is not eligible. So in a joint development project for a commercial construction, the GST payable on TDR is payable by the builder under RCM at the rate of 18%. The builder can also take ITC subject to Rule 42. Coming to the residential sector, we will take one example. There are 100 apartments. In a joint development, there are 100 apartments. This will give an example also and explain it further in the subsequent slides. Briefly, we will understand. Out of the 100 apartments, 50 apartments are for landowner, remaining 50 for the builder. So when the 50 apartments are handed over to the landowner, the builder is liable to pay GST over the 50 apartments. No doubt. The builder is liable to pay GST for the 50 apartments. Out of the remaining 50 apartments pertaining to the promoter share, let us assume 30 apartments are sold before CC. 30 apartments are sold before CC. So, out of 100 apartments, the builder will pay GST for 50 plus 30, 80 apartments. For 20 unsold apartments, he will not pay any GST because CC has been received. He will not pay any GST. So, the total GST payable on TDR under RCM, we have to quantify it. Then 80% of that is exempted. For the unsold apartment alone, GST is payable for TDR and the rate is also 5%. For commercial, I said it is 18%. For residential sector, please understand, it's a very complex web. For all the apartments sold by the builder, he will collect 5% GST from his buyer. For the apartments constructed for landowner, the builder will pay GST at what rate? That is a big question. I will come to that separately. That by itself is a separate question. For the time being, the builder will pay tax for all the apartments handed over to the landowner also. So in our example, for 50 apartments given to the landowner, the builder has paid GST. For the 30 apartments sold to the buyers, he collected GST from buyers and paid. Only for 20 apartments, he is not going to pay GST. This is on the outward supply. Now, come to the inward supply of TDR. So now, for a residential project, the total GST payable on TDR, we have to calculate. The rate is 5%. For affordable apartment, it is 1%. On that, 80% is exempted and only 20% is paid. We'll also see in an example which will make it more clear. Landowners entitled to avail ITC. So now, when the promoter is charging GST on the landowner can take ITC. That is what this notification says. See, one more issue I will point it out. Now, in a joint venture project, the builder is paying under 5%, 1%. Now the question is, for the apartments given to the landowner, at what rate the builder has to pay GST? It is a very, very contentious question where there can be a difference of opinion also. In my view, I'm not saying that my view is correct. Anyway, it has to be tested before a court of law. But in my view, the rate of GST payable by the builder towards the landowner for the apartments given to the landowner, it cannot be 5%. It should be 18%. Why? Because the 5% rate is prescribed under serial number 3 subclass 1. Serial number 3 subclass 1. It makes it a condition you can claim that particular rate of 5% only when the amount charged includes the value of the land also. When a builder is selling his apartment to a buyer, the price includes the land value also. That is why 1/3 is given as a deduction. But when flats are constructed for the landowner, there is no transfer of land from the builder to the landowner. He is constructing in the land owned by the landowner himself. So 5% rate cannot be applied towards the landowner. It should be 18%. So I'm making it very clear. Some professionals feel that 5% can also be adopted here. They also quote one FAQ issued by the government, but even after reading that FAQ, it does not deal with the rate between builder to landowner. It only talks about when the landowner subsequently sell it, what rate he can adopt. That is what the clarification is about. So, for the time being, you accept my view. You may disagree. That's a different point. So, for further proceedings, we will assume that the promoter is liable to pay tax at the rate of 18% for the landowner because there is no transfer of land involved. So 5% rate cannot be claimed. This notification says in a joint development project, for the apartments given to the landowner, the builder should pay GST. No problem. The builder will pay 18%. It also says the landowner is eligible to take ITC. Let us assume the project is still in the stage of construction. When the builder will pay GST for landowner flat, as per the notification, it is payable only upon completion certificate. Only when completion certificate is issued, the builder will pay the tax for the landowner portion. And by the time, even if the landowner, let us assume, has sold his share of the flat before obtaining completion certificate, then he cannot take any IT because the builder has not yet paid the tax. So whatever tax the landowner has to pay upon sale of his share of apartments, he has to collect it from the buyer and pay it out of his pocket. This ITC will come to him only upon completion certificate. Then what is the point in saying that you are eligible to take the credit? That is one big anomaly. It has to be rectified. Second thing, let us assume that the landowner is charging 5% GST from his buyers. If it is a new project, no option. He has to pay only 5%. The notification says, whenever you are paying that 5%, you are not eligible to take any ITC. At one place, you are saying that you are not eligible to take any ITC. On the other place, you are saying that the landowner can take ITC. There is a contradiction. So, which will prevail? We can argue the first restriction is a general restriction, whereas the second one is a specific one. So, the specific will prevail over the general. So, credit is eligible. And that notification also says, if the landowner takes the credit on the outward supply, the tax payable by him should not be less than the credit taken. Now we have seen that developer will charge 18% to the landowner. Let us assume the landowner is taking credit of that 18%. So how he will utilize the credit, that is a different issue. He cannot use it in this project because this credit will come to him only at the time of construction completion. So by the time he might have received most of the money from his buyers. So he can't do anything with the credit. Even assuming that he has taken the credit, then he cannot pay 5% GST. He should charge 18%. So now the promoter will sell his apartment with the 5% GST. The landowner will sell his apartment with the 18% GST. The buyers will get confused. Marketing will become a very. So these are all without properly appreciating the business model, without properly analyzing how the transactions are happening. These provisions have been framed. So that is why it is creating all these practical problems. So theoretically, the landowner is eligible to take the credit. That is what the notification says. Now, so far we were talking about TDR. It is under RCM. Rate is 18%. Till now, we have not seen how to value the TDR. So now we will see how to value the TDR. So value of TDR will be value of construction. See, landowner is giving TDR. He is receiving apartment. It's a barter transaction. So the value of TDR will be the value of apartment, and value of apartment will be the value of TDR. It's like a barter transaction. But as I already told you, from the landowner, it is not only TDR that is flowing. The landowner is also parting with his UDS land to the extent of builder's portion of the constructed area. The landowner is parting away his UDS. So, in my view, the value of TDR shall be the value of construction service provided by the promoter to landowner, the value of apartments received by the landowner minus the value of undivided share of the land transferred by the landowner to the promoter or his buyers. So this should be the value according to me. The notification does not say so. The notification only says value of TDR shall be equal to value of construction service. And we are going one step forward. The landowner is not only giving TDR, he is also actually giving his part of the land also. In turn, he is getting the apartment, so the value of the land should be reduced. That is the interpretation. Now, we will see an example, then this will be clear. So this example will make it clear. I just check, are there any questions in the chat? Now, we'll take one example. There is a landowner and promoter. They enter into a joint venture. That the total land available is 10,000 square feet. We can construct 20,000 square feet. 2 FSI, we can construct 20,000 square feet. 10 apartments are constructed. Each one 2,000 square feet, total 20,000 square feet. 10 apartments are constructed. One apartment is sold for 5,000 rupees per square feet. So the total price of one apartment will be 1 crore. So each apartment will be eligible to get 1,000 square feet UDS because 10,000 square feet land. So each one will get 1,000 square feet of UDS. The guideline value of UDS, we will assume the 1,000 square feet UDS value as per the government valuation is 20 lakhs. We will assume. Now, number of apartment for landowner 5, promoter 5, 50-50, 5. Now, the taxable value of each apartment sold by the promoter. The promoter will sell his 5 apartment for 1 crore. So he has to charge a GST from his buyer. So that valuation will be 2/3 of 1 crore into 7.5%. That is 5% of total 1 crore. So the GST per flat will be 5 lakhs. The builder, when he sells the flat, the GST will be 5 lakhs per flat. Now, taxable value of each apartment being constructed for landowner. See, in this 1 crore charge, even though the UDS value as per government valuation is 20 lakhs, as per GST purpose, it is 1/3. GST law presumes that 1 crore includes 1/3 value of the land. So if you reduce it, the value of the apartment comes to 66, 66, 667. I hope it is clear. The builder sells the apartment for 1 crore, 1/3 is land value. So the value of the building, the material and services is one apartment, 66 lakhs, 66,667. So the value of apartment given to the landowner if you charge GST on that, it will be 18%. So it will come to 12 lakhs per flat. Yeah, just to skip one or two lines, come to that value of TDR provided by landowner to. Now, we have to decide what is the TDR liability. The builder has to pay GST on the TDR under RCM. How to determine that? Value of TDR provided by landowner to promoter will be value of construction service provided by promoter to landowner minus value of UDS land transferred minus UDS value transferred. So what is the value of apartments received by landowner? 5 apartments, each apartment valued at 1 crore, out of which only 2/3 is the value of the apartment. So 5 into 1 crore into 2/3 minus value of UDS land transferred. So what is the total value of UDS land transferred? Here I have taken 20 lakhs as per the government valuation. We can also argue that we can take 1/3. When GST law presumes 1/3, we can take 1/3 also. But in this example, I have taken the government valuation. So of TDR service will be the total value of constructed apartments given to the landowner. 5 into 1 crore into 2/3 minus value of land transferred by the landowner. That is 5 into 20 lakhs. So 5 crore 66 lakh 66,667. On that, the GST payable will be, normally it will be 18%, but it has been reduced to 5%. For residential apartment, I have mentioned 18%, but it is 5%. GST payable on TDR is 5%. Now, here, if you extend this one more step, suppose if all the 5 flats of the builder share is sold before CC, then the builder need not pay any GST for TDR because all the 10 flats he is paying GST. 5 flats he is given to landowner, he has paid, and 5 flats he has sold to buyers also, there also he has charged. So TDR liability will be nil. Suppose out of the 5 flats, the builder is not able to sell 1 flat. At the time of CC, 1 flat is unsold. Then out of the total GST payable on TDR calculated in this method, only 1/10 is payable. Because for the remaining 9 flat, he is going to pay GST, only 1/10 is payable. So this is as far as the joint ventures are concerned. Now, this rule 42-43. Rule 42-43 will apply. In fact, I will correct. There are 2 mistakes in the slide. The earlier slide, it should be 5%. And this provisional reversal is not applicable for the construction sector. They have to do the reversal only at the time of completion of construction for the entire project. Now, they have to do proportionate reversal. How much area sold on payment of GST and how much area is remaining unsold at the time of completion certificate. This has to be calculated on a proportionate basis, and on that basis, the proportionate credit has to be reversed. And this will apply for commercial projects as well as ongoing project where the old rate is followed. If it is a pure residential project started after 1/4/2019, now another question. I mentioned for the flats handed over to the landowner, the builder is liable to pay 18%, not 5%, 18%. So once the builder is paying 18% for the landowner construction, to that extent ITC is eligible. Only when the builder is paying 5% for his buyers, ITC will not be eligible. But for the construction done for the landowner, where the builder is liable to pay at the rate of 18%, the builder is eligible to take the credit. So he will continue to take ITC and follow the provisions of Rule 42 and 43. For the flats handed over to the landowner, the builder is eligible to take the credit. Now, what will the landowner do with the credit? Suppose if the landowner is retaining the flat or selling it after completion, he cannot take any ITC. Suppose if he is selling it during the stage of the construction, theoretically he is eligible to take the credit. But because of the time gap between when the builder will pay the tax and when the landowner will be paying tax for the flat sold by him, practically it becomes difficult to take any credit. So otherwise, as per law, he is also eligible to take the credit. So this is as far as the provisions under Rule 42 and 43 are concerned. So with this, by and large, I have covered the applicability of service tax and the applicability of GST on construction service, the position from 1/7/2017 to 31/3/2019, and the lot of changes made with effect from 1/4/2019. So with whatever we can do within the short span of time, I have explained. So now we can move on to a question and answer session. I know that subject being very complex, people may be having a lot of questions. That is why we will have a little more time on this particular question and answer session. So now we will move on to question and answer session. And anybody wants to raise any question, please raise your hand and the admin can unmute them.
Participants, you can ask your questions.
Hello, sir. This is Vignesh.
Yes, sir.
Sir, you were explaining about this transfer of development rights paid on reverse charge basis. Whether now TDS reverse charge and not wait in its unsold.
Sir,
your audio is not proper. Can you
repeat?
Please be little closer or louder.
Sir, actually, when the flats remains unsold or when the commercial building remains unsold, whether reverse charge on TDR is applicable for both commercial as well as residential is my question.
Yes.
RCM
for commercial, whether it is unsold or sold, nothing is relevant. For the commercial project, joint venture project, GST on TDR is payable at the time of getting the completion certificate. At the time of getting the completion certificate, it is payable for the entire portion, sold or unsold, as far as commercial is concerned. Coming to a residential project, the TDR RCM is payable at the time of getting the completion certificate only to the extent of unsold apartments. For the apartments which are already sold before completion certificate, GST would have been charged from the buyers. So to that extent, the TDR GST is exempted. The TDR GST under RCM is exempted for residential sector alone for the apartments sold prior to issue of completion certificate. For the unsold apartment, to that extent, based on the proportionate area wise, GST is payable under RCM.
Okay.
I hope it is clear, right?
Yes, sir. Yes, sir. Yes, sir.
Hello.
Just to hello.
Yes, sir.
Can I ask the question? Good morning, sir. This is Murlidhar from Hyderabad.
Tell me, sir.
Sir, my question is, even under the earlier service tax regime and now also, one of the big points which is contentious is like, when this landowners portion and the builders portion, they get divided sometimes very much immediately after the main agreement is made. The supplemental agreement is made maybe within a month, sharing the property between these two. So the point to be discussed is as to when the amount is required to be paid by the developer. Sometimes even before construction actually takes place, the supplemental agreement takes place where they divide their portion. So what exactly would be your solution for this, sir?
Yes. So especially after 1/4/2019, there is no doubt on this aspect. They have said at the time of getting the completion certificate only, it is payable.
Sir.
So both under service tax period and prior to 1/4/2019, the wordings used are whenever the apartments meant for the landowner are conveyed through a conveyance deed or any other document. This is what the wording was there. So it can be interpreted either way. So once the allocation is done, joint venture agreement will be entered today. Once we get the plan sanction, everything, then a supplementary agreement can be entered and this flat is for landowner, that flat is for builder, that allocation can be made. So actually what is happening in that particular document, wherever the area allocation is being done, no conveyance is happening. It is only an agreement. This is meant for you. This is again an arguable. In fact, we have also taken the other stand. So it can be argued both ways. It can be argued both ways. We can treat it that this is a conveyance deed. In future, I am going to convey and this is how I am going to convey.
Correct.
So that is the document for allocation. So that is the relevant date for payment of liability by the builder to developer. Definitely we can take that particular stand. But wherever it is not properly not identified and the conveyance happens only finally, an allotment letter will be given. In such type of situations, only the final allotment letter will be treated as the point where the tax liability is payable. But if there is a clear demarcation, either in the supplementary agreement or sometime later, we can very well take up an argument saying that that is the relevant date for payment. But again, these are all highly debatable issues. It can be argued otherwise also if it is beneficial or some other manner. But by and large, this is my view.
Okay, sir. Thank you.
Sir, this is Dwaraknath.
Yes, my own personal partner of Hyderabad is asking a question.
My question, of course, Murali Anna has already asked it. We are taking this because the department, when they are issuing show cause notices in the erstwhile law of service tax, they were taking the value of the first apartment sold and demanding it from the date of supplementary agreement for the sake of interest. Anyway, this is not my question. Murali Anna asked and you have clarified properly. Now, my question is, 5 apartments of the landowner are being charged to GST in the hands of developer, and if the landowner is selling in his hands, and the value of the developer's price of the apartment includes the cost of the 5 apartments, therefore there also it is suffering. Likewise, multiple taxation is made on the same thing. Can we challenge this in any court of law?
Very valid thing. See, the whole concept of GST is the tax on value addition. So at every stage where value addition is happening, tax is payable. To avoid the cascading effect of the taxes, the benefit of ITC has been given. So the benefit, generally, I'm not talking about the construction industry, generally the principle of GST is it's a value added tax, and at every stage of value addition, tax is payable. We cannot argue, I have not answered your question, please give me some time. So we cannot take up a stand that the tax has to be charged only at the final point, So the tax will be at every point of value addition, which will lead to cascading effect, no doubt. But the cascading effect has been taken care of by providing the ITC liability. But coming to this particular construction sector, because of the rate of tax has been kept at a lower level, especially at the request of the industry, that ITC facility has been bought. It is a conscious decision by the government to bring down the tax rate and at the same time disallow the ITC also. So what happens? Because of that, it appears that the tax is being suffered at different stages once again and all. So it cannot be challenged as if it is a violation or anything. It is all our own making. We wanted a lesser rate, government gave a lesser rate, but with conditions of no ITC. So this cannot per se be challenged. One more thing, if you, as I have explained, whatever GST charged by the builder to the landowner, technically credit can be availed. The notification says the landowner can take the credit also. And what will happen when the landowner sells his flat? When the landowner sells his share of the flat, the tax charged by him should not be less than this 18%. So what can he do? He can tell the buyer, I will not charge any GST on you, because 18% GST is coming as credit to him from the builder. The taking 18% credit, he can also charge 18% credit and use the entire credit for payment of the tax. And he can tell the buyer, I will not charge you any GST. So then what will happen? If you buy a flat from builder, he will charge you 5%. But if you buy a flat from landowner, he can give it for a lesser price. These are all a lot of imbalances. And again, technically you are eligible to take the credit in this given situation. But as I said earlier, this credit will come only upon completion certificate. But if I am doing the sales before that, the landowner is selling his share, these are all the problems. We have to accept these are all the problems. There are no solutions. Coming back to your query, just because the tax is levied at 2 stages, it is adding to the liability. Per se, it cannot be challenged in my view. Any others?
Yeah, sir. Sir, this is Nagaraj. Thank you, sir. It's a very excellent presentation. Actually, I have some practical doubts, sir. It's about, suppose in residential complex, suppose I take a 5 apartments, and later I give it to rent to some other like CA firm and audit law firms, which is to be business. You can do it. Maybe you can do it in residential apartment also. You can do that type of business. Can I take what I paid in that 5% GST as a input to pay here as output liability?
Yes, sir. Now, as per law, section 17.5, you are not eligible to take the credit. It says any construction services received only up to the main contractor level, credit can be taken. But the ultimate point, credit is specifically barred under section 17.5 for the construction related services. But you may also be aware, recently the Orissa High Court, they read down the provision. They said that the 17.5 is wrong. Once they are going to rent out the property, on the rent when GST is payable, you should not have restricted. That's a very bold decision. Even though the law, the section says it is not eligible, they have struck down that particular section and allowed the credit. And promptly, government has also filed appeal in the Supreme Court. So finally, what will happen, we don't know. So as of now, you may say that as per the Orissa High Court judgment, I will take the credit. But the department will definitely say that you are not eligible for the credit and litigation will come. And finally, the issue has to be decided based on what the Supreme Court is going to decide in the Orissa case. So technically, as per law, as per section 17.5, in your case, you are not eligible to take the credit. Maybe based on the judgment, you can take the credit and fight it out. That is the only solution.
Suppose it is a commercial complex, can I
Same view.
Commercial complex also?
Yes, sir. Yes.
Okay, so thank you.
Sir, Mani, can I ask one question?
Yes, sir.
Sir, Natarajan sir, good morning. Sir, there are certain projects wherein the landowners, instead of transferring all these things, they are entering into revenue sharing.
Yes.
The construction cost, the builder is charging, say, suppose 5,000 rupees per SFT. Whatever they construct, they will take 1,000 rupees to be given to the landowner as part of the total construction area. This is one side of one part of the question. And second, after completion of this, suppose there are 20 apartments that are being constructed or 20 villas that are being constructed. So 1 or 2 villas will be given to the landowner, okay, which he may retain by himself or he may sell it to other person. If it is during construction, then it is taxable. After construction also, it is what you call, law is very clear. So can you
Explain. Yes. This I have not told. Yeah, I will explain this. Okay. Now, first we will take a case where it is purely revenue sharing model. No flats are given to the landowner.
Yes.
Only on every sale, 50% money will go to the landowner, 50% will be retained by the promoter.
Yes.
No construction. So in that case, the promoter is not providing any construction service to the landowner.
Yes, sir.
The promoter is not giving any building to the land. So the tax which was payable by the promoter for construction service provided to landowner, that is totally absent. That is not there.
Yes, sir.
But transfer of TDR is there. For transfer of TDR valuation, what we have to take, the total money received by the landowner. The landowner will be receiving 50% of the total sale proceeds. So what is the total money received by the landowner? That will be the value. From that, the total land, the owner is parting with the entire land. The land will be sold by the buyer. That land value has to be reduced. That will be the value of the TDR on which the buyer will be, the builder will be liable to pay tax under RCM. So only for TDR valuation, this will be relevant, and there will be no GST payment between landowner and promote. In fact, instead of area sharing model, revenue sharing model is a bit easier, and it will avoid many of the problems. This is the case of pure revenue sharing model.
Yes,
Suppose
sir.
let us assume it is a mixture. In 100 apartments, I don't want 50%, just to give me 10 apartments. Balance, you give me the revenue share. There again, the builder will be providing construction service to some extent, some 10 apartment or 1 apartment. So that has to be valued, and builder should pay GST on that particular apartment. When it comes to TDR valuation, we have to take up the value of that particular apartment plus the total revenue share received by the landowner minus the land parted by the landowner. So it will have an impact only in the TDR valuation, and whatever apartments given to the landowner, to that extent, the promoter will be liable to pay GST. So that is how this has to be done.
Under RCM.
RCM also, TDR RCM also.
Right, sir. Thank you, sir.
So I'm Nilesh Vitlani. I have a doubt.
Yeah.
Just to overcome the accumulation of ITC in the hands of landowners, can it be contractually agreed between the landowner and the developer that you raise periodical invoices, and so that the landowner, as and when he sells his share, gets the ITC?
See, that may not be correct. Why? Because if somebody has to take ITC, the conditions to be satisfied are you should receive an invoice, you should have received the service. That is one of the conditions. So here, when the service is received, that is a vexatious question to be decided. So the service can be said to be provided. There is a concept of time of supply. So once the time of supply arises at the supplier end, then the same thing we can say at the recipient end also. On the one hand, you are demanding tax from the supplier because time of supply has arisen. So once the time of supply has arisen at the supplier point of view, it should be deemed that I should have received the service also. I can take the credit. But in your example, when the developer, when the time of supply will arise, as per law, as per notification, that the time of supply is only at the time of getting the completion certificate. If he still voluntarily pays tax in advance, the jurisdictional officers of the promoter, they will be happy. They are getting the money in advance, they will be happy. They will not object. But at the landowner end, they will say that the promoter has paid the tax even before time of supply. So you have not yet received the services. So your credit availment is not proper. So that may be a problem. It cannot be done. Yes, sir. Anybody else has any questions? Yes, sir. So Chandramouli, you can unmute and ask.
So my only is like one small clarification. In a tripartite agreement, actually, like landowner will be there and builder will be there, and then buyer will be there. Wherein when land is sold as a with an agreement or MOU or something, and then taking some amount from the prospective buyer until the construction is happened, will there be any GST impact on that?
Definitely, sir. Definitely. Any amount received, any flats sold before completion certificate, any advances received, stage-wise payment received, everything is liable to GST. Suppose let us assume I have 10 apartments. I have sold 8 apartments before CC. So from that 8 buyers, I have received some money before CC, and they will continue to pay some money after CC also. But I am liable to pay GST on all the money received for the 8 apartments. Only for the 2 apartments which are not at all sold up to CC, I am not liable to pay GST. Otherwise, any apartment sold before obtaining CC, the amount received before obtaining CC, everything is liable to GST.
Okay, but even in a tripartite agreement also, when there is no construction activity started, before even the planning also got sanctioned from the government or whatever, still that advances received from the prospective buyers.
Advances are also liable to GST. Advances for services, they are also liable to GST. We have to pay immediately.
If you are selling as a land?
Even if you are selling it as a land, as per the law, the total amount received is presumed towards the total consideration, and 1/3 we can reduce. So even though you call it, the first 5 lakhs is only for land, but as per GST law, out of that 5 lakhs, only 1/3 is for land. So on the remaining 2/3, you are liable to pay.
Okay, sure. Thank you.
Somebody has asked, just a minute, is it possible to get a note on the difference between JDA, revenue sharing model, JDA and a revenue sharing model in a GST point of view? So let me take this opportunity, since you have triggered, I will also mention that I have written a book on GST sometime last year after these amendments have come, and the first edition of the book has been sold out. This book is currently not available in the market, and thanks to this lockdown. So once this lockdown started, I started updating this book with my second edition. So where I have exhaustively dealt with the revenue sharing model, some anti-profiteering decisions, some advance ruling decisions. All those things have been included in the second edition, and it has been completed. Now it has gone to the printer. So once the lockdown is over, the second edition of the book will be coming. So there is a detailed discussion on all these aspects. Whichever is not covered in the first part, that is also covered in the second part. You may kindly get it. So thanks you for giving me an opportunity to market my book.
Sir, will you mention the name of the publisher, sir?
Name of the publisher is Oakbridge, O-A-K. I'll just show this also. Oakbridge. It's also available in Amazon. Amazon also you can just, the title is
Amazon
Demystifying GST for Construction Industry. Demystifying GST for Construction Industry. It will be available in Amazon in all leading law bookstores. Oakbridge Publications. Yes.
Sir, good morning. This is Rama Prasad, a small query, sir.
Yes, sir.
Yeah. In case of an RREP, the tax is applicable at 5%. If it is a combination of a project of a residential and commercial, whatever the ITC accumulated in the commercial can be utilized for payment of the liability of a residential 5%, sir?
No. They specifically said this 5% has to be paid only in cash. Only in cash.
Sir, another one, sir. In case of a JDA with a income sharing rather than a plotting flats, the land value for the payment of a tax on TDR, the land value has to be an SRO rate or any other rate has to be adopted.
Again, it is we can say either the government valuation or the GST law presumes 1/3 as the value of the land. So we will also take the 1/3. So that will be more reasonable. Even though in my example I have taken the government valuation in the slide, it is better to take 1/3 because the GST notification itself recognizes 1/3. So we will go by the same.
Okay, sir. Thank you. Thanks, sir.
Sir, this is Krishna Reddy, sir.
Yes,
Hello?
sir. Yes, sir.
Sir, I have one doubt, sir. 1/4/2019 onwards, developer is paying 5% GST and is not taking ITC. Why? Because that condition is there. But at the same time, he is charging 18% to the landowner share. So he is eligible for credit.
Yes.
So he can apply for a Rule 42. Rule 42.
Yes. That is what. But, yes, proportionately he is eligible to Rule 40.
But developers are thinking from 1/4/2019 I am paying 5%, so I am not eligible for ITC. So this is the valuable answer.
Yes, see, ITC is not eligible only to that extent of the apartments where 5% is paid.
Yes,
the law need not specifically say that. The fundamental principle of Rule 42 is, if you are providing a taxable activity and an exempted activity. So here the 5% is also something like an exempted activity because ITC is barred. So when you are doing both, proportionate unit is always eligible. No problem.
Thank you.
మీరు ఫోన్ చేసినప్పుడు నేను ఈరోజు కొంచెం లేట్ అయింది, పొద్దున్నే లేచాను కానీ మళ్ళీ పడుకున్నా. సరే స్నానం చేసి పూజ చేసుకోవడానికి లేట్ అయింది. ఏదో
can you please translate or in English?
Sir,
yes, sir.
Sir, please. No, sir. I think he's on call.
Okay.
Sir, administrator, sir, can you mute him?
No problem.
Yeah.
Now it is not.
Okay. Sir, coming to the first queries question, sir.
That's what I said. Amazon says the book is unavailable because the first edition has been completely sold out. Please wait for some time. The second edition, from my end, I have completed my work and I have sent to the publisher. Editing work is going on. Maybe in another 15-20 days, because of the lockdown, it is getting slightly delayed. So try after some 15-20 days. Then it will be available. Yes, sir. Yes, Mr.
Sir, regarding the first queries question, sir, regarding payment of GST on development rights, sir, is it liable under RCM, sir, or the landowner has to collect from the builder and pay it? With respect to commercial, I am saying, sir.
Even in respect to commercial, it is only RCM. Only the builder has to pay.
Okay, sir. Thank you, sir.
This is after 1/4/2019. So any project before 1/4/2019, there is no RCM. The landowner has to pay.
Landowner has to. Okay.
Yes.
Sir, this is Dwaraknath. Thank you very much. It's a wonderful experience. My simple request is, can you give the bottom line? How many times or on how many ways the developer has to pay the GST? Otherwise, thank you very much.
The life of a developer has become very, very miserable, especially after 1/4/2019. So even for the people like us who day in and day out read all these provisions, it looks so difficult. So whether you will concentrate on your business or you will 24 hours, you will think only about the GST. Situation is really pathetic. You have to take up with, as I said in the beginning, all this problem is only because of ourselves. We wanted a lesser rate. So once it is without ITC, actually the cost goes up. You cannot reduce, but all our buyers, they are all very much aware nowadays. They will say, no, GST rate is reduced by the government, you have not reduced the price. So like that, they will ask. But the real fact is, because of this rate reduction, your cost will go up because no ITC. So all of you, please talk among yourself through your forums like Builders Association and CRIDA and all. Take up the issue, try to find out some amicable solution with the government. So that is the only way out. Otherwise, the present set of provisions, I do agree, it is very, very difficult to comply with.
Sir, hello.
Yes, sir.
Sir, Muralidhar here once again.
Yes, sir.
Sir, I want to have one discussion with you, small discussion. As you rightly said, because of this Orissa High Court, the small owners and then other construction activities which are being let out for warehouses and others, slightly they have got some better footing now. But the point is, I think we should ask this CRIDA and others also to take it up, because these people are investing very heavy amount on account of various services and construction activities.
Yes,
I know of a guy who is actually has constructed 3 lakh square feet for ITC and then given to them. Unfortunately, they cannot pass on that GST to them.
Yes.
And then there is always, I think this as a body of association, they should take it up, because since they are paying revenue, they should also be able to take the kind of ITC so that this cascading effect does not take place.
Definitely.
All the malls, warehouses particularly, I have been telling these people, I don't know, I think from your side, since you are senior and then you have got more number of clients, I think you should take it up, sir.
Definitely.
Thank you so much.
Thank you.
Any other questions, participants? Sir, I think we got one, sir, in the chat box.
Yeah. In case of a residential apartment construction, whether the builder needs to pay GST on labor contract and RCM basis. See, there is no direct RCM, but you have to take that labor cost also and all other input services. Whether 80% is received from a registered person, you have to do it every year. If there is a shortfall, if you are not received your input and input services, including labor contractor, at least 80% from registered person. For the shortage, you are liable to pay 18% under RCM. But otherwise, all labor contractor, directly there is no reverse charge. Only this threshold of 18% has been prescribed. If you are falling short of it, you have to pay. Now, one more question. How about GST implication on the JDA for conversion of land into plots, area-based model, while taxing the TDR? Should we reduce the value of land pertaining to the landowner, like we have done for it? It should be allowed there also. Basically, there is not much of a difference. So the same logic should apply in development of flat also. Same logic should apply. Anyway, it requires a little more study also, but prima facie, I feel that the same principle will apply there also. So are we supposed to pay GST on unsold flats even if we own the land? No. If you are doing it on your own land, a project, if there are unsold flats, if you are selling it after completion certificate, you are not liable to pay any GST. This is only for JDA. For unsold flat under RCM, we have to pay. I think with that we can close. I think some of the questions have been answered. Any more questions are left? Okay. Thank you for all the participants and thank you.